The next U.S. government institution that promotes home ownership is the Department of Veteran Affairs. These loans are so-called VA guaranteed loans or just VA loans. As part of the GI Bill of Rights, veterans are able to obtain mortgage loans that are guaranteed by the Department of Veterans Affairs with little or no down payment and loan interest rates. VA loans also have lending limits. VA loans work as follows. Private lenders make these guaranteed loans to qualified veterans, but the lenders are protected from risk of default by a guarantee from the Department of Veterans Affairs that assures repayment of the loan in the event the borrowing veterans default on the debt. These loans are guaranteed, not insured, so no premium is charged to the borrower. Instead, these loans charge an upfront funding fee. Both VA and FHA loans are referred to as non-conventional loans. So all other loans are called conventional loans. These are important terms in the world of real estate financing. Another government institution that was created to support and promote home ownership in the U.S. is the Federal National Mortgage Association, or short Fannie Mae. Fannie Mae was originally created as a government agency in 1938. At the time, it had the following two purposes. First, it was supposed to buy FH-insured mortgages that were originated by lenders, then package these mortgages into securities that are backed by the mortgages, and then sell these securities to investors. Therefore, Fannie Mae essentially created a secondary market for FHA loans. It is important that an organization buys loans from the banks because banks do not have unlimited funds. Once their assets are used up, they cannot make any more loans. But if they can sell off at least some of their loans, then they can use the proceeds to originate more loans. Remember that the U.S. government wants banks to make mortgages because it wants people to own their own homes. Fannie Mae's second purpose was to provide FHA loans to low-income borrowers that could otherwise not get a mortgage. While Fannie Mae started out as a government agency, it was converted to a private company in 1968. Since 1970, Fannie started trading as a public company under the symbol FNM on the New York Stock Exchange. However, even as a public company, Fannie Mae was still what is called a government-sponsored enterprise, or GSE. It was chartered by Congress with a mission to provide liquidity and stability to the U.S. housing markets. In 2005, before the mortgage crisis, Fannie was the third largest company in the U.S. To show you how tied in with the government Fannie Mae was at that time, Fannie Mae had 1/3 of its board appointed by the President of the United States. Also, if it needed money, the Treasury could lend money to Fannie Mae. Because of its close ties with the government, many people thought that Fannie was a very safe investment. I remember pulling up the stock quote of Fannie Mae in 2005 and showed my students an interesting statistic for the company. The percentage of its investors that were institutional investors. It was over 90%. As you probably know, large institutional investors such as life insurance companies, mutual funds, banks, and pension funds have very strict guidelines as to which investments they can hold. Institutional investors can only hold safe institutional-grade investments. It is interesting to see that most everyone in 2005 thought that Fannie Mae was a safe investment. In the fall of 2007, however, the mortgage crisis took a toll on Fannie Mae. As home values started to fall and borrowers started to default on loans that were held by Fannie Mae, its profits slumped and its investors were becoming very worried about the company. As they started to sell their shares, the stock price crashed. The sell-off was so dramatic that the financial viability of Fannie Mae became questionable. The total collapse of Fannie Mae had to be avoided. So on September 6, 2008, the director of the Federal Housing Finance Agency, the FHFA, James Lockhart, appointed the FHFA as the conservator of Fannie Mae. A conservator is basically a guardian who oversees an entity's financial affairs. In other words, the U.S. Congress seized control of Fannie Mae by placing it into conservatorship. In addition, the U.S. Treasury also agreed to provide up to $100 billion of capital as needed to ensure that the company would continue to provide liquidity to the housing and mortgage markets. Under all circumstances, the government wanted to avoid the collapse of the U.S. housing finance system. On June 16, 2010, after pretty much all the common equity in Fannie Mae had been wiped out, Fannie Mae was delisted from the New York Stock Exchange. Beginning on July 8, 2010, Fannie Mae's common shares then started to be exclusively traded on the over-the-counter or OTC market called the Bulletin Board, which is a place smaller companies and penny stocks trade. The ticker symbol from Fannie was changed to FNMA. Today, Fannie Mae purchases all types of mortgage loans from originators and either keeps them in inventory or repackages these loans into mortgage-backed securities, MBSs, that are then sold to investors. At this point, politicians are trying to figure out the future of Fannie Mae. It may eventually wind down and cease to exist altogether, but what will replace it? That remains to be seen. Here you can see a Fannie Mae price chart between 1977 and 2019. You can clearly see how the common equity was wiped out within a very short period of time. It traded a high of $86.75 on October 1st, 2000. In April of 2007, the stock had lost value, but was still trading at over $65 per share. On June 30th, 2008, the price had crashed down in the wake of the financial crisis to only $1.53 per share. The Government National Mortgage Association, or Ginnie Mae, is another government organization that was created to promote home ownership. It was created in 1968 as a federal agency with the purpose to provide subsidized FHA loans to borrowers. You may remember that Fannie Mae started being a private company in 1968. Up until that point, Fannie Mae was making subsidized FHA loans, but it stopped making these in 1968. Therefore, Ginnie Mae basically took over this function from Fannie. Any losses that occur from subsidized FHA loans are ultimately covered by the Department of Housing and Urban Development, or HUD. In 1970, Ginnie Mae introduced a program that guarantees the timely payment of principal and interest on FHA and VA mortgages. This guarantee made FHA and VA mortgage-backed securities even more attractive to the secondary market participants. The Federal Home Loan Mortgage Corporation, or short Freddie Mac, is another government agency that was established to support the U.S. housing finance system. Just like Fannie Mae, it is a government-sponsored enterprise, or GSE. But it was created in 1970, over 3 decades after Fannie Mae was. Its purpose was to create and operate a secondary mortgage market for conventional mortgages, which are all loans that are not FHA or VA loans. These include loans with private mortgage insurance and loans that do not have any mortgage insurance. Freddie Mac started trading as a public company under the symbol FRE on the New York Stock Exchange in 1989. Just like Fannie Mae, Freddie Mac was converted from a government agency to a public company with ties to the government and is called a government-sponsored enterprise, or GSE. After the mortgage crisis started, Freddie Mac had a very similar fate to Fannie Mae's. Its stock price started to fall at the end of 2007, and by the end of 2008, pretty much all of its common equity was wiped out. Just like Fannie Mae, Freddie Mac was also put into conservatorship by Congress on September 6, 2008. Fannie and Freddie together received over $100 billion in government bailout funds. The government invested money into the preferred stock and debt of the two companies to make sure that they do not completely dissolve as they were still an important part of the US housing finance system and promote home ownership. By the way, just like Fannie Mae, Freddie Mac used to have over 90% institutional ownership and ironically was considered a safe investment up until 2007. What is particularly interesting about the 90% institutional ownership is that both Freddie Mac and Fannie Mae were part of a group of companies that also included Enron, Tyco, and Adelphia that were accused of financial reporting irregularities in the early 2000s. These accounting scandals ultimately led to the Sarbanes-Oxley Act that had the purpose of protecting investors from fraudulent accounting practices by corporations. In a 2003 article, the Wall Street Journal stated that both companies' accounting statements were so convoluted that they were pretty much unanalyzable. I remember telling my students, why would anyone want to invest in companies that have financial statements that are unanalyzable and, on top of that, do not even properly report their financials? Well, I guess I was right in the end. On June 16, 2010, Freddie Mac, just like Fannie Mae, was delisted from the New York Stock Exchange and started trading over the counter. Its new ticker symbol on the bulletin board was now FMCC. Today, while trading over the counter, Freddie Mac competes with Fannie Mae in the market for all types of mortgages and mortgage-backed securities. When new banking regulations started to come out in 2008 after the mortgage crisis, the Obama administration was supposed to end government control over both Fannie and Freddie by January 2011 and completely dissolve them. Well, as of the time of this recording, Fannie Mae and Freddie Mac are still around. Both were supposed to be dissolved by the new deadline of 2018, which has now passed. So at this time, the future of Fannie and Freddie is unknown. This is the price chart of Freddie Mac from its inception in 1989 until 2019. You can see the resemblance of this chart to the Fannie Mae price chart. Freddie traded at over $74 per share at its height at the end of 2004. By the summer of 2007, it was still trading at over $61 per share. But by September 1st, 2008, its share price had crashed to only $1.71.